Okay, welcome. Thank you for being here. We are super excited and happy to be here in Salt Lake City in the Fundication Studios, broadcasting live as we usually do, but on Zoom, but actually in the studio. And so we're super excited to be here. This will be the second time that we've been talking about PREIshare. And so welcome. Thank you for being here. We can see that you're there, but we can't hear you. So feel free to ask questions in the chat box in the Q&A as we go along. And please ask them as they come to mind, because we have a lot of people coming on today. We'll get to as many as possible. Our objective today is to share with you, as you've read in the invitation, the progress and the purpose and the intent of PREIshare, and share more details about why it's important to the real estate business for syndicators, lenders, investors, and so forth. And sponsors. So with that, thank you all for being here again. And Michael, you want to just give us a little background?
Sure. So I've been in the real estate business for over 40 years. I am a CCIM. My background in real estate was syndication. 35 years of that was spent syndicating multifamily properties throughout the United States, large multifamily communities. And I guess about 5.5 years ago, I sold that business to my partner with the intent of retiring. Realized I had no retirement skills whatsoever. Still couldn't golf. Just because you retire doesn't mean all of a sudden you're going to drop 5 strokes off your score. Yeah. And so I really started sitting down with Kent and some of the people I've been in business with for years, and said, we need to do something for the syndication industry. And so we kind of came up with the ideas around the concepts that led to PREIshare. And so that leads me to today. That's what we're here to discuss.
Yeah, and we're going to get into the details of what those details are and why it's important. But Kent, you want to give us a little background? And by the way, I didn't really know this, but aside from Michael's background and success, and when you survive 40 years in the real estate business or any business, then that says something. But Kent has some really interesting background too, institutionally, and then working together in the real estate business.
Yes, I did work in institutional investments for a little over 20 years, and I remember Mike telling me our family history goes back 4 generations in real estate, and he kept on saying to me, he says, "This is where you need to be." And I kept on saying, "No, I like where I'm at," and then he said, "Well, it's the information age, and it's going to be changing our industry too." And the real estate industry has resisted that, but I did finally, for a number of reasons, come over and get involved in real estate syndication with Mike. And I'm anxious to see what we're going to be doing with those changes coming up in the coming years with PREIshare, because there's some things that have, as I work in the real estate syndication, that we're missing in the industry that are going to help the investors and the sponsors, I think, significantly in the coming years.
So it's repeated itself time and again where somebody has been involved knee deep in the execution of a variety of businesses, and they see things that you wouldn't otherwise see, that can be improved upon, innovation, fixed. And so one would argue that when the big reveal about why this is so important, if we can just synthesize and encapsulate the thing that's really important that you're solving, that you saw needed to be solved, and would help the investors, the sponsors, and so forth.
Well, the biggest thing I think that I saw over the years is that as the CEO of the company I was before, one of the biggest issues in investing in real estate is that it's illiquid, which is true if you own the real estate directly. But as syndication or syndicators, we were not selling direct ownership in the real estate. We're selling an interest in the company that owned the real estate. So that would have been SPE, a lot of different forms for that to take, and they've kind of morphed over the years to what's preferable. But so basically, we still continue with that myth that, hey, real estate's illiquid. And the reason I think we perpetuated that as syndicators, and we're all guilty of that, we've been guilty of it for years, is that we knew that was actually a liquid asset. It could be sold because it was just a security interest in that underlying SPE.
That incremental amount of the SPE.
Right.
Yeah.
And so, but we were in the real estate business. We're not in the business of securities. We didn't want to be in the business of buying and selling our own securities, certainly, or doing it on the behalf of our customers, our investors. And so we just labeled it illiquid. So we're locking up your money for 5 to 10 years. The net result of that is you had probably only 3, our records indicated we only get 3 out of 7 people that were inquiring about investing with us that would actually invest. And we had great performance. The whole 35 years that we were doing multifamily, superior performance. Outperformed pretty much any kind of investment you could pick.
So just 3 out of 7 was what you would successfully get a deployment. The balance would have a variety of reasons, but often it's illiquidity for not investing.
Yeah.
And so that metric was more than you're able to raise enough money even with only 3 out of 7 not pushing back.
Sure. So and number one reason for that was because the 7 that wouldn't invest because it was illiquid. I mean, these were people that sought us out,
Right.
or were interested, but that was the point that just said, look, I can't have you tie up my money 5 to 10 years because I don't know that I'm not going to need it in that period of time. And beyond that, there was another argument is, how do you know what the future looks like 5 to 10 years from now? And no one has that crystal ball.
Right.
So those were the kind of 2 reasons, but a lot of them were kind of all centric around the locking up the money for that length of a period of time. And so that was the first thing that we looked at, and we just said, why did we do that? And why don't we fix that? And so we got with our real estate securities guys that we'd worked with for years and said, any reason why we can't do this? And after some very expensive research, they concluded, no, there's no reason not to do that. Yeah. And so one of the things we thought about is that, and I'm sure Kent's got a deeper background on it than I do, but if you just increase that incrementally by 20 to 30%, let's say you got 5 out of that, a couple of things would happen. One is that because if you were able to start providing liquidity to that investment, you would have 20, 30% more investors. Already we've seen one of the reasons that real estate values have gone up is because there is a surplus of investors, chasing too few deals. Right. It's a supply-demand equation. Yeah. Add more to that equation, what it's going to do is likely drive down the cost of equity. And that does a lot of wonderful things for the business. Mm-hmm. So if you think from the standpoint of just how that would pencil out in the pro forma, so you'd go maybe from a hurdle rate of 9% pref to your investors to maybe moving down to a 6% pref. And it lowers then the delta between debt and equity, which would encourage, for a number of reasons, would encourage a syndicator to use less debt and more equity.
Yeah, and less debt means less likely to get crushed in a downturn, like gives you longevity, right?
Correct.
Yeah.
I mean, what we're seeing today in today's market is the crisis that's forming is over debt. Debt can't be restructured. It's being restructured at a prohibitive price. And so there's only one way that I can really see that real estate goes to zero value is when the bank gets it.
Right. You throw the keys back, right?
Yeah. When you give the keys back, your investment went to zero.
Yeah.
Otherwise, it doesn't happen. So our hope was that, and we believe when we model this out, we'll lower the cost of equity, but not necessarily the return. And I hope we have time to explain, because there's a way to greatly improve your equity on a shorter term investment, the return on your investment by shortening the investment term. But we'll de-risk the industry substantially by doing that. And so that was kind of the fundamental core concept we built PREIshare on. So
to oversimplify it, the providing liquidity for what is nomenclature used in securities is secondary market, right? Same thing here, but I think that's a common term. You had mentioned something prior, that the syndicators, the sponsors, have no interest in facilitating a sale of secondaries because they're chasing money to either fill up the fund or go on to the next raise. So it's of little or no interest facilitating that sort of secondary market. It's like you have fun, go find somebody who can buy it. Contracts usually say first right of refusal for the GP or the balance of the LPs. You strike out there, and then you have to race around and find, somebody who was interested in buying your LP interest it's basically what we're talking about, right?
Right, and they still have to meet the accreditation requirements.
Right. And so, by the way, this is a good time, since most everybody who's come on is on, for me to say, usually I have no economic interest in the people that present in Family Office Insights, and so I just want to disclose on the record that I have a really keen interest in the success of PREIshare and a shareholder. So just full disclosure, on the record, disclosure's king, just want to be clear about that. Ken, one of the things you talked about is the benefits of, and I'm going to use my words, so forgive me, buying a secondary interest in something that has burned off some of the stuff that would, in the early years of an investment, that makes the investment more interesting because it's now 3 years into the maturity or stabilization of a real estate.
That definitely is a big advantage of having a secondary market. Usually when these investors see a deal, a passive investment deal, and that's been or that somebody's going to syndicate, it's all based on pro forma of the deal. And maybe there's some history of how somebody else managed before that sponsor now acquires it and puts it out to their investors. But if it's a property that's been undermanaged or has some other changes to it, all of that's not been tested yet. And so somebody coming into a new deal like that doesn't have the benefit of hindsight that the secondary market is going to provide. So now you've got a deal that's been 2 or 3 years in the market. It's been tested. It's got a track record you can value on that investment.
Right. As opposed to speculating. Right?
Yes,
Yeah.
and often I suspect on the secondary market, because the underlying investment has not been sold, all the upside hasn't been recognized yet. Somebody putting that out there on the secondary market has a reason why they're trying to do that anyway, and they may be willing to give you a good price on that, maybe even better than what they paid for it to begin with. So often giving you a lot of the upside that's been gained in that 2 or 3 years from repositioning that asset or whatever the sponsor was doing on it.
So going back to Michael, in order to, I've seen the sausage being made, and it's not as bad as it sounds, meaning that everything's in place at PREIshare to execute on this, almost. Just detail stuff, and I'm not trying to trivialize them because they're important. But let's talk about the execution, right? You raise money into the fund so the fund can stand ready to do a variety of things and create the hub to post the secondaries. Is that about straightforward as it is?
Sure. So it's we wanted to provide, first of all, a the secondary marketplace, which would be the listing hub, that has really nothing to do with the fund, other than the fund, for lack of better terms, poaches from that source of product.
Right.
So the fund itself will have its own defined criteria. It will look for, certain asset classes that we believe are very strong. It will also look in certain geographies and with certain sponsors that we vetted. So when we see those come up, we'll be very interested in acquiring those. But beyond that, because, for example, we probably won't be investing in like triple net. Might be, I'm not precluding that, but triple net is not something right now that would be on our radar or in certain geographical areas. But for other people, it might be very attractive. So that's where they could go to look at those opportunities, and then they can price in what they would like to offer for those. And then, so you would have the current cash flow, the current performance information on it for probably the trailing 12 at least, maybe the trailing 36 months in some cases, where then you could determine, what kind of risk you'd put on that, and then make a discount according to that. So, but the fund would use that as primarily their sourcing location for product that they wanted to buy.
So I just want to oversimplify it. Right now, if anybody's attending or otherwise, the opportunity as an investor is precisely what?
So as an investor, to invest in the fund, it would be the way we're going to operate this fund, first of all, it will be liquid because that's what we do. So at any time you can take, and the way we're structuring it, the engineering behind how the fund investment works, you get a quarterly report that says this is what's going to be available. We've done one now, but it included some alternative investment for us, which would be like pref equity, which is more relationship building with sponsors. We're probably going to fund that a different way after some feedback from investors, but you'll see what we're currently looking to buy. And then you can vote with your checkbook. You would reserve a certain percentage of the fund, the total fund, by a deposit, which would be 10% against the total amount that you want to reserve for your investment over the term of the life of the fund. And then from there, every quarter you would look at our deal flow and say, yeah, I think I'm going to make the investment. It's not like you're buying that one individual asset. You're just continuing to reinvest in the fund. And if you don't, that's not a big deal. You can step back and say, I'm going to hold off on this quarter because of whatever reason.
Any variety of reasons.
Any variety of reasons. And all that happens is that on the next quarterly, then you kind of go back to the back of the queue for reinvestment opportunity. But you stay in that opportunity flow. And then the other thing that's nice about it is that you can, we'll make those quarterly distributions from profits and gains. So eventually, if you think about it, if the average life cycle of one of these investments is 2 to 3 years, after about 2 to 3 years, we'll be turning a large percentage of the portfolio over.
Yeah.
So you'll have gains.
Yeah.
And that's how you increase your yield, is because instead of a 5 to 10 year life cycle, you might turn that same cash investment 3 to 4 times in that period of time, or 2 to 3 times. And so you can take those gains and reinvest them, or you can take them off the table. You can take the principal off the table, and you can take any of the cash flow off the table or reinvest it on a quarterly basis. So at some point in time, the fund becomes sort of self-funding.
Yeah.
Depending on the level of participation from our investors.
So a 10%, a commitment with a 10% deployment initially gets you to in the game, and then on a quarterly basis you can decide to draw down on the balance of your commitment to the extent you'd like to in that. Every time you get an offer to do it, you can fill that bucket, and if you don't, you go back to the...
Yeah, you just cycle back.
Yeah, totally makes sense. All right, so that's clear for the investor. And just for the record, there's in the operating company, there's no opportunity for investors, or yes?
You know, we get that question all the time. People hear the business concept and it's like, absolutely, we're interested.
Yeah.
I think before we did that, I would like to fully develop this out and have a year or two track record with it.
Yeah.
There's a lot of, I would say, horizontal and vertical relationships in the real estate marketplace that want to take an interest with us, in what we're doing.
I asked the question on purpose.
I know
mean,
you
I've
do, and
seen
every
it
time
happen, right?
we sit down, every time we sit down and talk about this, I know you have your specific levels of interest, but I suspect, and I probably will not. I don't know what will be the decision of the board at this time at that time, but I suspect that it would make sense at some point in time to offer the warrants to our current investors.
Yeah.
And say, look, if this thing is going to go public, or if there's that level of interest, if we're going to be bought out by
Yeah.
something else, is put the warrants out and let our current investors have the option to take some of that gain.
Yeah.
I think that would be reasonable and fair.
Yeah.
But it's just not in the planning phase right now. Right now, we're just trying to figure out how to get our arms around what is obviously a pretty sizable market demand
Yeah.
for this.
So we've talked about the investors, and we can come back to that, but let's talk about the other holders. So let's talk about those who have second LP interest in something that they would like to put on the hub, for example. That's how they would, in a commercial way, see if there's an opportunity if somebody would want to buy it, right? And so what's that process like?
We're still finishing up that process right now to get that done. The design of that should be done here very soon. But we're trying to make it as electronically efficient as we possibly can for the investors to be able to put their information in there. We hope someday that we'll be able to have the relationships with companies that do the dashboards and accounting for those investors, where they can just push a button and eventually, when they push that button, it says, yeah, I'd be interested in listing when I have all the information that
Just
the investor
APIs
has.
into it, yeah.
Goes right into it,
Yeah.
that's right down. But initially, right now, what the process will be is they would have to put in the information on what the deal is and post any of the offering documents that they received when they put it together, and of course, actual financials that they put in there, and if the financials don't have it, information on the track record on the distributions that they received as well. And then we're also working on the sponsor side.
That was going to be the next, right?
A sponsor database where it would make it easier then for investors putting their offering out there, putting their existing deal out there, where they would be able to select the sponsor that they work with, and all that track record and history on that sponsor would automatically come in.
And so the barrier, if at all, which I happen to know a lot of people have signed up, the barrier is qualification as a sponsor, right?
Yes.
Yeah, I mean, that's something that investors usually don't have enough information on. And that's one of the things our company is working on in terms of qualification standard. Given Mike and I and others in the company have a substantial history in working with real estate syndication and working with investors, we've been very investor oriented over that time period. We know what the investors are looking for, and there's a lot more sponsors out there in the market nowadays than there were before. And the one thing that will distinguish them is a standard that the industry needs in terms of what level of service that sponsor provides. Their transparency on their financials, getting things done timely, how often they meet with their investors, those kinds of things.
Do they get the K1s out on time?
The K1s on time, yes.
Seems to be always a big hassle.
Or meeting their performer returns. Some sponsors, to get equity, sometimes will overpromise and underdeliver, and we prefer to work with sponsors that do the opposite. And so this is a standard that we're putting out for the industry that'll be the PREIshare qualified sponsors that meet some very specific criteria that across the board the investors want to see happen.
So for us, that's not to say that you could have a sponsor that's not qualified by us, hasn't been vetted by our services. Their investors can list on the listing hub, but there will be a moniker that we'll put on there that says this one is through an approved sponsor.
Right.
And the only reason we would do that is just say that we have vetted that sponsor, and that means that we would invest with that sponsor. And I think we're going to revet every sponsor on every offering. So that just, for us, that also tells us that would be one that we'd be interested in investing in. It has that potential because we have looked at that sponsor and believe that they're investment worthy, for lack of a better definition. But it doesn't mean that we know all the great sponsors out there.
Of course,
So there, so we're not going to make that determination, and we're not going to say, hey, just because we vetted them, they are great, or because we haven't vetted them, they're not great. So that's open to everybody. But as part of the service we provided to our sponsors that are signing up, because what they're doing is they're altering their operating agreements to allow this. So the differentiation is if they've got the approval stamp on them, one of the things for certain, they've authorized.
Their documents allow it to happen.
There are documents. And if they don't have it, then we've got to go back and give them amendments to their existing operating agreements or their offering statements that allow for that to happen.
So I don't want to necessarily get into the weeds about that, but it's an important point, right? What is it about the incumbent operating agreements that would not allow this to happen?
Well, you said standard, what they all say, pretty much every one of them I've ever seen, all the ones we ever wrote, said the same thing. You can offer it back to the sponsor. If the sponsor doesn't want it, you can offer it back to the other members of that limited liability company or whatever that legal entity was. If they don't want it, then you can go sell it. But then you still have to go back and have the sponsor approve that. You cannot change that because the sponsor has the responsibility to stay in Reg D compliance by vetting that new investor and replacing them.
Right.
So that's the process. So what you want to do is circumvent that process of saying, let us look at it. If we don't want it, then let these guys look at it. And if they don't want it, then you can go take it to market.
Right.
Why not just take it to market? Because everybody would have the same right and interest. And it's in their investors' best interest to give it the greatest exposure they can right out of the gate.
Yeah.
It doesn't preclude the sponsor from buying. It doesn't preclude anybody else on that. In that
Cap, or the other LPs or whatever.
It's in that cap table.
Yeah.
They can certainly go make an offer on it.
Yeah.
And it's going to be a little bit more competitive because you've got a lot more potential buyers. You know, if you limit it just to the people that are fellow members of the LLC, that's a pretty limited group of people. And my experience has been on that most people don't recognize all the upside that's been achieved at that point. And so an investor wanting to sell it really has a limited group of people. And as a result, the perception continues that real estate is illiquid when it doesn't need to be.
Yeah.
Which is another reason why, Mike talked earlier about the lower cost of equity, and I was going to add to that. With sponsors, seeing interest rates go up, cap rates decompressing right afterwards, it's been more difficult for them to get the financing and everything that they need to get deals to work. Sponsors then, recognizing the short-sightedness of what has happened in the past, can see the opportunity that they have now. Sponsors looking at this can say, okay, I've got, yes, like Mike talked about, a lot more potential investors, which drives down the cost of that. But investors coming in, their return expectations are also going to be a lot less because it's not, instead of an illiquid investment they're buying, which would drive up their return expectations, they now have a secondary market option because that sponsor allowed that. Mm-hmm. That's going to drive down their return requirements, which again adds to lowering the cost of equity.
Less risk.
Yeah. What I see happening here with this is an industry changing opportunity. I think, for those who get involved, the sponsors and their investors. In the past, sometimes I don't think that the sponsors' needs and what they were after always met up with what the investors were trying to do, what they wanted to do. And the reason was because of all the things that we've been talking about here. And I think PREIshare is going to, with offering the secondary market and the fund approach that we're doing, is going to change an awful lot of that and bring together those two groups in a way that the industry's needed to do. And I think since there are so many sponsors out there that they're competing against each other, it's going to be an opportunity for the sponsors that see this and really look at this the way the investors want to look at it. It's going to be a huge opportunity for them, and certainly will be for the investors coming into it as well.
One thing I want to add to that, because we talk about it because I'm an investor myself. And we say, well, it will lower the rate of return for investors, right? Because
Equity.
yeah, the return on equity.
Yeah.
So that's true only in the short term. So one of the things that the great advantage anybody that's invested any length of time realizes where the real gain and wealth comes from is anytime you have a capital event. And those have always been one of two things. They've always been either the refinance of the property, which will give you some of your
Recapitalize, take some money off the table. Right. Yeah.
right, with the intent that you can reinvest that.
Right.
So that gives you a compounding effect and allows you to recapture those gains. Because equity in itself is market driven, or even just from paying off the loan or the debt, or the principal amount of debt, that's really an illusion of wealth until you capture it. Because the market can take it away from you just as fast as it gave it to you. So if you have an ability to either do it through a refinance or a sale, that was the tools that everybody had. In this market, you can't get a refinance because
You don't want it.
You're refinancing out of 4% money into 7 or 8% money. No one's doing that.
Yeah.
So that's off the table. Sales is off the table because prices are depressed. So, but if you could take short-term recapitalization every 2 years or whatever it is that give you your capital gains treatment, what that does for you is it allows you to compound. So take your gain out, reinvest it, especially when something like PREIshare can give you continual deal flow, where you can actually find that reinvestment. Then all of a sudden you see the returns on that initial investment start to really ramp up.
Yeah.
And so that gives you the possibilities of having much higher returns than the original hurdle rates or anything else because of that recapture and gain.
Yeah.
So it gives you that third tool, and the wonderful thing about that third tool as an investor for me is I'm in control of it.
Yeah. As opposed to the sponsor deciding when
It's going to be.
have a capital event, monetize an asset,
Yeah.
whatever, recapitalize, right?
Right.
Yeah, super interesting. Because so embedded in that lower return is actually opportunity with the ability to monetize incremental parts of your LP interest. Embedded in there is actually lower risk and higher return.
Right.
I mean, did I overstate that?
No.
No,
Yeah.
and from a fund perspective, one of the things I like about what's happening here with the secondary market, the fund going out and buying these deals many times at a discount. But let's just say that the investors get stingy and they want to say, no, I want at least get out what I put in, and say, fine, we'll go with that.
Yeah.
And doing, looking across the return that the project would normally receive. Let's say that many sponsors try to achieve an equity multiple of 2.0. So you're going to get that. Hopefully that's the standard that the fund investments received. Well, if you're going to achieve that, like Mike was talking about, say half the time, and you paid par for that, for whatever it is that the investor put into it, that return, that 2.0 equity multiple, achieving that in half the amount of time.
What's that tell you?
Yeah, and then compounding that,
Yeah.
you can see what that's going to do to the IRR of the fund.
Yeah.
it's phenomenal to be able to do that. It's dynamically releveraging your money much more quickly.
Yeah.
Everywhere you look at the financial model around that, it just totally makes sense. One of the things that's always bothered me is that you talk to an investor, you say, well, we're talking about return on investment. And it's like, which investment? Your original investment or the current value of your investment?
Yeah.
You know, the equity gain.
Right.
And you say, okay, even if you take away, Arthur, you just take away gain through market. You know, so
Yeah.
the market's down.
Appreciation. Yeah.
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 And so then you look at it and you say, well, okay, but I've got somebody else paying my mortgage for me, which is paying my debt, which is that debt becomes, as soon as it's paid, is paid off. That principal portion of that is now equity for me.
Yeah.
And it's like, over time, your investment deleverages itself, which is great. It's de-risking. So you got a lower risk coefficient
Your
to the
equity's-
investment.
Yeah,
But
yeah.
the problem is that you get a lower return on that unrealized gain.
Yeah.
So that's one aspect. So you have diminishing returns over time. Over 5 to 10 years, they diminish quite a bit. So there's that element of it. And then the other aspect of it is that, and when we were talking to Don, your friend, he hit it right and nailed right on the head. Right now, if you bought 2 to 3 years ago, and you've got your property sitting on 3% debt, 3 or 4% debt, there's more value in the debt than there is in the real estate.
Yeah. How about that? Yeah.
And he's right.
Yeah.
And you know, you can recapture that just because of the value of having that kind of leverage on an asset.
Yeah.
So there's just so many ways to do this. But then if you just couple that with the fact that there's a reason why these people need to sell that asset, and I've seen everything from my wife is in the hospital and the insurance is not going to cover her medical bills to my kid has just got accepted into an Ivy League school and I had no idea how bad the tuition was going to be, but that's why I invested with you guys for, or I want a new Ferrari.
Yeah.
I have whatever the reason is, that means that when they put it on the market, it's going to have a discounting relative to that person's need, you know? And so, so not only that, for all of those factors, you're still buying into it at a discount, and the fund will be buying it at a discount. So that just makes, to me, the possibilities of getting above average return on very secure investment, you know, proven track record investment, not looking forward statements, but looking back, and not on a long-term basis, it just makes it a whole lot of sense because you've got all of the financial elements of time value of money and releveraging or compounding. All of those are now working for you in real estate where they were never there before, plus liquidity.
So oftentimes when you're looking at an opportunity, we talk about all the good stuff. Tell me a little bit about the pushbacks that you've got.
From a sponsor perspective, one of the worries that we heard one sponsor say, okay, you're putting a secondary market out there, and if I allow my investors then to be able to put those investments out there, and let's say several of them decide to do so, is that going to have a depressive effect on my deal? And I
also have a data point that pegs the value of the rest of the portfolio, right?
Yeah, and my
Or at least that
perception,
asset.
my perception generally of a sponsor that would suggest something like that is that it's not a sponsor that has a long track record in the industry, who's investor oriented, somebody that would worry about their deals going south because maybe they paid too much for them. That would be my suggestion. But if the sponsor's done their due diligence work properly on their investment and they've got a good track record and they haven't spent too much on their properties, that should never be a worry.
Yeah, and I'm not, a skilled, tenured real estate investor like you guys are, but I would argue, said a different way, that if they're trying to obfuscate something, then that just doesn't feel good.
No.
Right?
Transparency, like your very question you have, one of my experiences, or my experience in dealing with investors over the years, is I usually start with that kind of question to begin with.
Yeah.
What is it, the things that I've seen that people should be asking questions about that are potentially problems in the deal?
Yeah.
I like to talk about those first and be upfront and transparent with those things. And that's a real issue. It is a legitimate issue that a sponsor would have in working with this. But my experience also tells me, too, that it should be overcome by the fact that the sponsor has done a great job in being investor-oriented, and they do a great job in their due diligence in picking their deals, and they shouldn't be worried about that kind of thing.
Yeah, I really love the idea of being able to say to a sponsor, when you start reviewing them on their next offering, well, what's the trading range on your past offerings?
Yeah.
Off the secondary market.
Yeah.
I mean, that's the same kind of investment tool that you would use in the equities market.
Exactly. Yeah.
Is look at what was the trading range and what's been your recent performance. Now you would actually have that data.
Yeah.
So.
Yeah.
And I would maybe add one more thing
Sure.
to it, too. I think because of the interest of the secondary market, too, and the qualification of the sponsors, like Mike talked about, it'll overcome some of the perception potential investors have in investing in passively managed real estate that have been illiquid, that it's now liquid. It's going to drive more money towards those sponsors and should actually help improve the value of those deals.
Yeah. So I was noodling a little bit about how this would be perceived by lenders, the debt, people who are providing the debt. And I couldn't find anything that would suggest that they wouldn't see this as a net positive.
Yeah, all of them would dearly love to see you deleverage, and that would be a natural outcome of this, is deleverage deals. Our preference is going to be below 65% LTVs.
Yeah.
It just makes them far more secure in that investment. A lot of times, investors start changing their LTVs or their debt coverage ratios because they have to be competitive. The market forces them that way.
Yeah.
And if you're competing against equity as one of those sources in the cap table, and equity all of a sudden becomes far more attractive, that makes the ratios so much more favorable for the lenders. And it's forced there by market, not competitive to their fellow lenders, but competitive against the very source that
equity.
they need more of, and that's equity.
Yeah.
And if your cost of equity has gone down, it makes it a lot more feasible to attract the other 35% of equity you need for that capital stack.
And deleveraged deals, I've seen this forever. I mean, right now we're seeing the same thing. Deleveraged deals will usually get you 50 to 150 discounts and basis points, depending on how far you discount, or
on
how
the
far on the debt,
Yeah.
just by deleveraging.
Yeah.
So all the way around, it brings a lot of sanity and sort of a stabilizing gravitational force into the real estate market.
Yeah.
So the few lenders I've talked to about it, it's like needed that 3 or 4 months ago, or 2 or 3 years ago.
Yeah. And there's regulatory pressure too, right? Even some of the lenders are private lenders, and they're not traditional banking institutions, but there are, regulatory pressures for some of the large institutional banking lenders, right? I mean, there's pressure on them to have LTVs that make more sense, so when they get the keys thrown back at them, they're not totally smoked, right?
Right.
Absolutely.
Right.
Yeah.
Yeah, we don't want to have happen what happened back in 2008, 2009, where, the build-up prior to that, the LTVs were just way too high.
Yeah.
And
Market pressures, like you were saying. Yeah.
And sponsors that, again, went into that with some foresight and being able to see what, and because they've got longer history perhaps in doing it, could see that was irresponsible to put together deals with 80% LTVs.
Yeah. So I think that a good outcome for the attendees here is just to have a really basic and good understanding of what we're doing here, right? I mean, I think we've accomplished that today. So if somebody wanted to invest in the fund and somebody, sponsor wanted to come and get on the platform, and somebody has a secondary interest that they want to put on the listing hub, the path is clear on how to do that. Just let's get on the website, call us. You know, I'm saying us because I have an interest, but you know, there's no barrier to get this done in short order, right?
No, just give us a call or go to the website, and all the information is there.
It's PREIshare.com / get invested.
Yeah.
And all the documents are there, the form information. You can see that we project above average returns, and we give you the reasons why. A lot of we just discussed. It's a very simple, straightforward process. Then you can make a soft commitment, and then when you want to lock out how much percentage of the fund you want, be able to invest in over the next 5, 10, 15 years, whatever it is, then you just make your deposit. So that process is easy if you've got the listing hub. We'll be launching the listing hub. We're in beta right now. I think we've got one more review next week, and then it goes live. So that goes up, and so you can, if you've got a fractional interest you want to get out, rid of. We've got a number of people that say, as soon as you launch the listing hub, we'd like to get on that so we can free up some cash to invest with you.
Right. Yeah.
So it's sort of
find some money.
Yeah. Also, it's going to be this sort of catch-22 thing, but yeah, that's kind of where we're at with it. It's a pretty straightforward process.
And we're going to be doing that ourselves, investing in it as well. So.
Yeah.
I was the first guy to pull the trigger on it. I had to be, just because of.
Totally makes sense.
Yeah. So I've already
voted with your checkbook, did you?
I did. I absolutely did.
Yeah.
So I reserved that. I'm starting to second guess. I would maybe want to increase my stake a little bit, but because it doesn't really make sense to. I was thinking I want to make a reserve out $1 million, so I put my 100,000. Then I'm thinking, what's the difference? I put up 200,000, reserve $2 million, and then if I shrink back, that 200,000 still is within my $1 million original scope. So I'm starting to think maybe I'm going to re-up that. I don't know.
Yeah. You know, I think being that you guys are so experienced in the real estate business, and there's a lot of talk about what is happening across the board in every asset class in the real estate, I think the audience would appreciate if you wouldn't mind a little editorial about what's not. I'm not suggesting you prognosticate, but sort of your sentiment in the real estate business in general.
Based on current market conditions?
Yeah, where are we headed? Like I'm not saying predict, but how are you feeling about it?
I can go ahead and start with that one.
Yeah.
As I talked about earlier, we've seen a lot of increasing interest rates. It's made it very difficult for sponsors to get deals. I think there's going to be some sponsors that will probably drop out because of that. Other sponsors that have longer term focus, I think will see the opportunity in this and be able to find deals that will still work for them because of the lower cost of equity that
But
they'll
definitely
have.
calling out the herd right now.
It is, and that's
It's like a cleansing, right?
yeah. And there probably needs to be. There are an awful lot of syndicators out there nowadays. I think we trained a number of them.
Yeah. For a while there, we were running the University of How to Be a Syndicator.
Yeah, we did. We did, and it was interesting. A lot of people say I could do that and make that work, but many of them did, and many of them didn't. But there does probably need to be a calling of the herd, as Mike said it there, and I think we're going to see sponsors that are going to look beyond what is going on nowadays and see some opportunities in this. That this could actually help them in their business plan.
Yeah, makes sense.
There's going to be a tremendous amount of transference of wealth in this period, which is, I've always been on the receiving side of that. I think, Arthur, I've shown you some of my track record in there.
Totally.
And
Right place, right time.
Yeah, absolutely. I've lived with one motto for probably 40 years and don't ever waste a recession. We never have. We might not even make a recession on this, but there's some substantial devaluation going on, which always creates opportunity, and it's easy to get on the other side of that. But for me, now I kind of wince at that. Is that in that situation we discussed where we bought at 4.5 cents on the dollar and prosecuted at 48 cents on the dollar on that one asset package that was back in 2008. I had to remind myself, in order for me to have that kind of win, somebody had to have that kind of loss. And that is a testament to how bad or how inefficient the real estate market system is.
Yeah.
That we have to have those boom and bust kind of cycles. And that's why I'm not so engaged. I'm trying to take advantage of this downturn this time. I'm trying to make sure we don't have another one that has that kind of sway in the market. I'd like to see things just a little bit more, not such a wavy
Less
sine curve,
volatile,
but a
less
little less
peaks and valleys,
a lot less volatility in the market.
And I
going
think this
forward.
could help stabilize that, you know, because you're bringing potentially a lot more buyers in there, and that's when the downside occurs, is when there's not enough buyers.
Yeah.
And if there's some buyers that are willing to buy, maybe get some good deals in the process, because maybe they've got a contrarian approach in their investment philosophy, and they're thinking, well, these are some pretty good buys that I can pick up now at a pretty good price.
If you think about it, every one of these we've had, except for the one in 82, well, in 86, which I'm dating myself.
TRA 86.
At TRA 86. That
Yes.
was because of tax reform.
Yeah.
Right.
So, and when we were syndicating in 86, I was doing shopping centers in 86. We were selling tax shelter. We were not selling real estate.
Yeah, it was
it
tax
was just,
shelter,
we
yeah.
just made tax problems go away.
Yeah.
And Ronald Reagan said, nope, don't like that.
Yeah.
Get, a couple of changes and whammo. Savings and loans went out of business, but that was different. Everyone since then, like 2008, people will recognize that was a debt crisis. It's always around the function of debt in real estate, with that one exclusion in my career. And so that tells me that let's get less reliant on debt, and let's stop over leveraging deals, and let's not assume that we're going to get 3% rates, and the debt fairies are going to give us that kind of debt rates into an eternity. It just doesn't work that way.
Yeah.
So as an industry, if we can decide that we're going to operate in more sane environments, then you will get that more stable environment, which I don't know. The old me says, I kind of like the crazy ups and downs, because if you know how to ride that roller coaster, it can be pretty thrilling, and you can make a lot of money at it. But too many people got hurt in that.
Yeah.
But from sponsors who are investor oriented, they don't appreciate that because their investors don't.
No.
Right.
Yeah.
Talk about alignment, right?
Yeah.
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 And and the number of sponsors are going to pay the price for that. Where maybe they did an awful lot of deals that didn't have fixed interest rates in them. Not just the problem with the LTV, but also just to, this is the way they bought the deal. They overpaid for it, but to get it to work, they put in too much leverage to get it the interest rate that they needed. They were willing to give up a fixed interest rate, and many of those kinds of sponsors and their deals are not going to be. They're not going to be able to save those kind of deals. Maybe opportunities for other people, but not the kind of deals that I think we would want for the fund, or for qualified a PREIshare qualified sponsor. It's just not the way. We want sponsors who are really investor oriented and have a longer term focus.
It's kind of like you don't have to.
Yeah.
Like you don't have to go down that road, right?
Yeah, you don't have
Yeah.
to do that.
Yeah.
So if you look at what we're doing, it's true, it's a real estate backed asset, but we're really just selling cash cheap. We're selling, we're selling cash flow at a 70% discount.
Yeah.
Or at a 30% discount.
Yeah.
And so, or thereabouts, and giving you the chance to take the gains when you want to take them. And it's like, to me, that's so simple and so straightforward, but why that has not been in the marketplace before. But that's why I want to be the first guy to pull the trigger on it, because I really see that as a tremendous opportunity to be able to control my own investment like that.
Yeah, as I did. So I appreciate being part of it, really do.
Well, and the other thing, the sponsors, in addition to the 7 out of 10 investors that wouldn't invest in real estate, it's going to bring an awful lot of additional investors to those sponsors because they chose to open up.
Allow that to happen.
Yes, exactly.
Yeah. Actually, it's a great selling point.
Yeah.
That's market driven.
Yeah.
Yeah.
Once that gets out, that'll all be market driven.
So I know I promised I was going to get to all the questions, and we didn't, but we'll make sure we get to them separately by email or otherwise, but we'll make sure everybody's in touch with Kent and Michael, and super appreciate everybody being here. And it's always a joy to be with you guys. And
Enjoyed it.
It's been super interesting ride so far. As I always say, thank you all for being here and sharing with us the only thing you can't make more of, and that's your time. Till next time. Thanks, guys.
Thank
Thank
you.
you.
Okay.